recognition and classic technical analysis skills. Leslie, welcome.
Thank you very much, Jordan, and hello, everybody, and welcome, whatever time zones that you happen to be in. Thank you to the Money Show for the invitation. I'm very excited to present this topic today. We're going to talk about contraction and expansion phases and how the AB equals CD pattern shows up in both of those phases. We have a short amount of time today, so if I do not have time to get to questions, I have quite a few slides and information to cover. Please feel free to email me. You'll see it at the bottom of the slide. That's right there, or just visit my website and email me from there. Okay, let's get started. Some of you may be familiar with this book, but this book will cover the AB equals CD pattern and other patterns in that. And I have a special that you'll see on my website if you visit. And risk disclosure in case some of you don't realize that there might be risk in trading. And this presentation is for educational purposes only. So what we're going to cover today is we're going to cover briefly the AB equals CD pattern if you are new to it. And it is a brief overview of it, and expansion and contraction phases and the patterns that tend to form in both contraction and expansion phases and different ways of using them, and then the AB equals CD pattern in the ranges versus trends. The AB equals CD pattern is a basic pattern. It was first described in the 1935 book, Profits in the Stock Market by H.M. Gartley. And as you can see on this slide, it's a simple lightning bolt type of shape. The buy patterns is on the left side of the chart, and the lightning bolt is coming down. The deep point of the pattern is what we call the completion, and that's where traders look for entry signals around that point. On the right side of this chart is the AB equals CD sell pattern, lightning bolt shape, and the decompletion point is when the market is moving to the upside. But the structure, we'll talk about the structure briefly with this pattern, and it has three legs. The first leg is labeled A to B, and then the retracement leg is the B to C, and then the final leg is the C to D. Now, we can use Fibonacci ratios to help define this structure, such as the B to C leg. The retracement leg may be anywhere from a 0.382, a rather shallow retracement, to a deeper retracement, possibly around a 0.786, and occasionally they can even be what would be like a double top or a double bottom at the 1.0. And it's important to point out that the D point, the last leg, the C to D, it's not always exactly equal to the AB. It is in many instances, but there are a good amount of times where there's an extension of this leg, and that might be a 1.27, a little bit longer than the AB, or 1.618, even a 2.0. But that's something that if you are interested in this pattern, that should be studied. The markets, they only do one of three things, and we're going to look at old and new examples of this. They move up. Here's an example of an uptrend, higher highs and higher lows. They move down in a downtrend, lower highs, lower lows. Or they move sideways in a range. And that's it. That is all that that's all that they do. This chart is a chart from a book that I have, 1922 is the copyright on it by W.P. Hamilton. And we're looking at a chart that goes from 1902 to 1922. And you can see what I just said, that the markets only do one of three things. They go down, they go up, they go sideways, they go up, they go down, they range, and they trend. That's what they do. So if we can learn to understand the different phases, and when the market is going into ranging contraction type phase, or it's ready to come out of the contraction phase into an expansion phase, we can adjust our trading methods for the different market environments. So let's talk a little bit about the contraction phases. They constantly go through this. They contract, they expand, back to contracting, back to expansion. And these phases are also fractal. So we'll see these occur on the smallest of time frames, a 1-minute chart up to monthly charts and longer. We just looked at the chart of 1902 to 1922, and we can see that phenomena of the contraction expansion phases occurring. The contracting phases are range trading, and those are where prices are going to be testing support resistance area, creating support resistance areas, and they can also be consolidation patterns during a trend before the trend continues. And while the contracting phases, if you think of them as times in the market where the market is storing energy, there's a battle going on between the bulls and the bears, and eventually one side is going to win, and that stored energy is going to be coming out of that contracting phase into an expansion phase. While the ranges might be going through a process of starting out larger ranges and then coming down to smaller ranges. But during the contracting phase, that we're going to see patterns such as different coiling patterns, and we're going to discuss some of those and look at examples of those specifically on some charts in just a few minutes. So the markets, because they're constantly in one of these phases, there's a ripple effect, and there's always some sort of trend, even if it's in the range and the coiling, the contraction phase. There's still some trend. It's either an uptrend coming up to test resistance, or it could be a downtrend within that range coming down to test support. And we can think of the movements, because the markets are like energy, as the ripple effects of the size of momentum. And we want to learn to have some tools where we can measure that momentum that can tell us and verify that we're in a contracting phase and possibly ready to come out into the expansion phase. So let's talk now about some of the patterns that we'll see in both ranges and trends, and that these patterns also most commonly will form AB equals CD patterns within these patterns. The ABCD pattern can form on its own, but it also is part of these other patterns. So we have triangle patterns and other types of coiling formations, such as a pennant formation, rectangles, which I call a money box because the nature of those patterns is a long rectangle, and then eventually it's going to break out one direction or another. And so I call it the money box because that's the time you pull the money out of the box on the breakouts. And ABCD patterns also form within bull flags and bear flags. Head and shoulder patterns, topping patterns, and the bottoming patterns, the inverse head and shoulder pattern, these are always going to have an ABCD in them because that's the nature of how the pattern is formed. If you think about a head and shoulder pattern, you have the top of the pattern, it moves down, it has a retracement up, and then another leg out of it. So there's always going to be an AB equals CD pattern, but it's a whole nother topic on what you do with that ABCD pattern. And then retracement patterns also, such as the Gartley AB equals CD pattern. The Gartley pattern is a retracement pattern where you have a high or a low, and you have an AB equal CD swing within that high and low. So now we have an example up on the screen on the left side of a market that is in a contracting a range environment versus the right side where we have an expanding of price out of a range. And on the left side, you see this blue horizontal line. Almost all times when a market is in a range or coiling phase, no matter what time frame you see it on, there's going to be a center point where the price is going to trade up and around many, many times. So if we look at the left-hand side, we can see this price level where the price came up to it, sort of hangs on, trades around it, a little bit down, back up to it, around, forms the lower end of the range and back up and down. I mean, look how many times the price came to this level. So as you're learning this, learn to find that center point, because this will likely be the point that the market eventually moves away from. So it's an important, this is an important concept when you're studying range trading to keep in mind. And this is also true if you're using like parallel channels. You're also going to see center lines form with that. On the right side, we see an expansion phase. We can see down here there was kind of a sideways movement prior to this. And then here it price went sideways again. And then finally broke out, and then a long extreme bar to the upside out of that coiling process. So now let's look at some examples in a range of these patterns that form. This is very common to see, very typical. I hear and I read in a lot of books that, oh, you cannot trade ranges like this. Well, I really disagree very strongly with that. I say, yes, you can if you really study your market environments and the particular patterns, and you have a trading plan that is geared towards that type of trading. So let's start on the left-hand side. And here we have a A, a B, a C, a D a sell pattern with some retracement back down. And within that, we had an A, a B, a C, D, and a buy pattern. This area up here, I didn't want to clutter this chart too much, but you can see A, B, C, D. This is called a butterfly cell, and this is covered in the book Trade What You See. And that's when you have an A, B, C, D that extends above a previous high or a low point if it's a buy pattern. Down here we have, in this area, we have an inverse head and shoulder pattern, and then we have a A, B, C, D sell pattern. Market comes back down. More support down here, testing the support. Another A, B, C, D that I didn't mark in. But then we form a head and shoulders pattern and back down to the lower end. And then it eventually creates this triangle pattern and a breakout of that triangle to the upside. So this is pretty typical of the types of patterns that you can see and trade within the ranges. And I'm going to show you another pattern that H.M. Gartley talked about in his 1935 book, which is an excellent book. If you love technical analysis and reading about the old masters, I would really suggest it. But I want to mention one more thing before we move to that chart, that within this range, there's all types of smaller kind of micro contraction and expansion phases going on. Here's contraction with the head and shoulder and some expansion. Here we have some more contraction and a little bit of expansion back down. So when you're looking at ranges, one of the clues that you're in a range is that you do get these swift turning points. So you think the market's starting to trend up, and then all of a sudden it comes down and it quickly and swiftly reverses. Those are clues that you're starting to form a range. So here's a dynamite triangle. This is right out of Gartley's book. I copied it out of that book, figure 18. And it shows you the small little triangles. These can be hard to see on charts, so you really have to study this. But they are called dynamite because it says it's followed by a sharp movement from 2 to 8 days, which is from 3 to 4 times the amplitude of the pattern itself. So this is a pattern that is worth studying. And this is part of a consolidation of a trending move that's underway, a strong trend. Now, another pattern I'd like to bring your attention to is out of Shea Backward's book, 1930 book, Stock Market Theory and Practice, and this is one of my books as well. And he talks about this ascending bottom right here. And you can see, this coiling process, the range, and then the market starts to make these higher lows from here. And you can see he says that the major movement is the ascending bottom, is preparing for that major movement. So let's take a look now at an example. That was from almost 100 years ago. So let's look at something that was more current. Microsoft went into a range for 14 years. And within this 14-year period, we have A, B, C, Ds. We have the sideways, rectangles. We have triangles within here. We have all those patterns. And then we have the ascending bottom occur here before this breakout to the upside. Once it starts to trend, we start to see A, B, C, D patterns, A, B, C, D patterns, dynamite triangle in there, flag patterns, and so on. So it's really a classic example of that process and that pattern. And this is from another book, and this is looking at a period from 1897 to 1926 by Hamilton again. And this is a 30-year period that we're looking at of up, down, sideways before an upside breakout that occurred in 1924 and 1925. And notice the similarities over here on this ascending bottom type formation. And this, of course, this uptrend ended in 1929. But very interesting to study these old, really masters of technical analysis, the fathers of technical analysis. So let's get to a couple of charts and look at the contracting range in Johnson & Johnson and some of the patterns that formed within that. So for a trading tactic of using these patterns, the ABCD patterns within them, first thing you have to do is you have to learn to identify the market environment that you're in. So the range trading, you're going to expect to see reversals near highs and lows of the range that are forming that support and resistance. And again, it's important to find where that kind of center is that the prices are trading constantly around. On this example, we can see where the head and shoulder pattern is, that that is the price level. I probably should have extended that back, but if we just follow that line back, you can see that that's the price level that the market was really testing. Down at the bottom, A, B, C, D sell, back down for a test of the low of the range. What I did was, instead of marking in all the A, B, C, D, I just put the sell patterns with the D completion in red and the buy points in green on A, B, C, D. So we didn't clutter everything too much. But we have the money box, or little money box pattern down here sideways. We have an ascending bottom type of pattern with this triangle. And then you can see how this is really where the market started to break to the upside. Being able to recognize this pattern early and then knowing it has to get through this type of resistance to keep going, then this upper resistance can really give you an edge into an earlier entry into this type of pattern, and then your expectation is that there's a potential trend with it. But again, we see pretty much all the patterns that we just discussed with this. And here's an example of ABCD patterns in the direction of a downtrend. And I mentioned this fractal. This is on a 5-minute chart. I mean, we've looked at charts now that went decades, and we've looked at some intraday 60 minutes. Now we're coming down to a 5-minute chart, and we can see these same principles occurring here. On the far left-hand side, you can see there was a little sideways range that preceded the down move. Will break out to the downside on there. And then this is a Gartley ABCD because it's got this swing here. Preceding it, the ABCD is contained within that swing. The market continues downward. And you might see ABCD buys, but because you can recognize this as a trending environment, the clues that you've picked up before you get to here, which is what you want to strive for, because we can't see this whole trend when we're up here. So you have to have better tools to be able to identify and say, yes, this is now a trending condition. We've got triangles, another ABCD buy, and then more move to the downside. You'll see some of the corrections are very similar in price, and we see that on all time frames. So your trading tactic, again, is different in the trending environment than it is in a range. The range is more conducive to doing profit targets, retracements, etc. The trending environment is more conducive to holding, maybe scaling, taking some position, part of the position on, then back on, off and then back on again. So you have to come up with your trading plan for your range, recognize you're in the range versus the trend. I purposely did not put a label on this pattern. If anybody wants to email me if they recognize this, I will send you I'll send you something for being able to do that. But here is an example of an uptrend market, and this is very, very recent. I'll give you a clue. It's very recent. And I wanted to, kind of hit home the point that these are fractal in nature. And so all I'll say, it's not a monthly and it's not a weekly chart. So if you can tell me the time frame and the market, I will send you something really nice. Okay, so up here, we can see here, I mentioned that the ABCD is part of flags. And so here's an example of a bull flag ABCD patterns, quite common to see these. Now, the advantage of working with the ABCD within a trending environment within one of these patterns is many times these will give you measured move targets. So you can take the beginning, the length of the flag, and then at the breakout point of the flag, you can project that to the upside, and that can give you a target to work with. And so if you're trading multiple shares, contracts, whatever, it gives you an opportunity to maybe reduce some of the risk in the trade, take some profits, maybe trail stop on the remaining portion. But we can see here we also have ABCD buys. Here's our money box, ABCD. Here's a little dynamite triangle, more ABCDs all the way up in this trend, and finally a gap up, another ABCD in this triangle, another breakout. So I think that's a really nice example. So again, in a fractal nature of this process is constantly happening. We don't, I could show you this could be a monthly chart, but it's not. It's smaller, so the winner I will sense to be nice. But the important thing to remember, but because it is a trend, the patterns such as the triangles, the flags, dynamite triangles, money box, head and shoulders, you can utilize a measured move and project targets with these. And you can also use moving averages or even price levels, previous support resistance areas also can be used to help trail stops. And again, ranges are better suited for retracement targets and coming back into retests of support and resistance areas. This is a very recent chart. This is just from Thursday, and this is a sideways consolidation that happened in the S&P 500. This is the intraday chart. It's a 60-minute chart, and you can see the ABCDs. You can see the smaller coiling patterns on this. This was the FOMC day in here where the market came up. Could not quite get any higher than that, and then failed to the downside. Perfect test right here of coming back to the range. Now on this, when I wrote my notes and did this chart, I wrote in my notes that it has not formed an AB equals CD yet, but it will. Well, let's take a look at the next chart. And this morning, off the open, this includes the Globex session, 60-minute ABCD sell pattern. This is a 382 retracement, which is pretty normal for if you've had a strong trend to only get to the 0.382 or maybe the 0.50. And sometimes if it's very, very strong, it'll just be shy of the 0.382. So I think that's pretty good. As recent as I could get of an example for you. So in summary, you want to, in the contraction phases, you want to first identify the market environment that you're in. So look at methods to identify the ranges in the contracting phases, which we talked about. You have the swift reversals, test of support resistance. There'll be a center line that forms, and your trading approach should reflect that. So the best way to learn it is to go and study charts and just pull up lots and lots of charts and find the contraction range phases and study those, and then do the same thing for your trending. So in our expansion phase, again, you want to look at methods of identifying trend with patterns out of ranges. What we've looked at some very good ones today. And the trends are going to break the range decisively. And that phase of the trend should also have its own trading plan. So study the charts with that, and you'll start to get the hang of it. And then I want to quickly let you know that I've got a monthly subscription, $29, and I will send you a free copy of Essentials of Trading if you want to join us for our weekly market setups. It's got a ton of tutorial videos and articles included with that. And so that is it. Feel free to email me any questions, and if we have a couple of minutes for any questions,
Leslie, can you hear me okay?
Yes.
Excellent. We've got a few questions. We've got a few minutes left. Let's go ahead and jump right into it, okay?
Okay.
All right. So how do you determine the validation of D as an entry point? The market could go back up and trend upwards.
Well, first I showed you a lot of charts, current charts from just yesterday and the day before. This AB equals CD is a very, very common pattern that occurs in ranges and trends. As the market is approaching, as when you suspect that it's completed the B to C retracement, and now you suspect that the C to D leg, you know that you can figure out in advance where those completion points are. Let me see if I can back up to a chart. So let's just take the example of this right here, A, B, C, D. I can have this drawn in on my screen as soon as this starts to turn up. So right around here in these bars, I know that I'm expecting the D point to come into this price area. The red line here is just the extension that I talked about. That would be the 127 extension, which the market extended to that and then turned down from that. So if I know the length of A to B and then I have the retracement, I can calculate easily where the D completion points are. So here's an example here, A, B, C, D of today's. You know the length of A to B. This is Ensign software, and they have a great drawing tool that actually puts this drawing tool in. You can draw it right out, and it'll tell you where those points are. But it's easy to do by hand as well.
Thank you, Leslie. Our next question is, what time frames do you frequently use for your charting?
I use quite a variety of time frames, and I utilize a process combining intraday time frames all the way down to 400 tick charts, all the way up to weekly and monthly charts.
Okay, I think that's all the time we have for questions right now. Leslie, do you want to just go ahead and display your contact details one more time for your website for everyone to see?
Yes. Yes, and if there's any individual charts somebody would like, please feel free to contact me. I don't send out the entire PowerPoint, but I'm happy to send out an individual chart. So if you just come to tradingliveonline.com, you come see what programs I have. I have a self-study program that has a ton of information for traders that want to study this approach to trading. And then, of course, you can just come with us on the weekly market setups. I show you what I'm looking at for setups the next week, and lots of videos and articles that you can learn from.
All right, Leslie, thank you so much for joining us today. I'm going to go back and take back the screen for a second here.
Yeah, I would like to thank everybody for joining me today. Thank you.